we'll just leave this first slide up to explain that you need to connect both by video and separately by audio for those who are connecting for the first time. So this webcast, we're going to go for the next 2 hours, and let's just cover what we have for today. So today we're going to talk about the year-end closing process for the foreign private issuers, companies listed in the US. Almost all of them are using IFRS as the base of their financial statements, and they're subject to the US regulation. And we have with us today Leandro Argito. Leandro, are you on the line?
Hello. Good morning, Kieran. Good morning, everyone.
Good morning, Leandro. And Guilaine, are you on the line, Guilaine?
Good morning, Kieran and everyone. I'm here.
Yeah, great. And also Gary.
Yeah, hi, Kieran. I'm here. Hi, everyone.
Hi. So actually, we have a mixture here. So Guilaine's based in the US and I guess close to Florham Park, and we have Gary in London. So this will be, I think this is the first time we've had people speaking from, I guess, different continents. So see how this goes. So I guess the idea today is to talk about the new regulations applicable for the FPIs for the Form 20F this year. What are the new potential regulations being discussed for future offerings and for future registration statements? What are the new IFRS standards applicable? And then I guess what are the focus for the PCAOB and the Auditor for this year? What are we expecting for disclosures and evaluations required in relation to COVID-19? And then the hot topics as well for the SEC comment letters that we're going to be expecting as well. This is just to explain, so this is a formal training program for those. It's registered with the Brazilian Federal Accounting Council, and there's a test at the end for those who wish to have that certificate. So we can issue certificates to anyone who attends 75% of the 2 hours. Thus, anyone who's on for 1.5 hours out of the 2 hours can issue you a certificate. And then if you want a certificate for the CRC purposes, you're going to have to stay on for 75% of the time and also get at least 3 of the 4 questions at the end correct. This is our theme is keep calm, carry on. Times are difficult for a lot of us, and we just hope that everyone can keep calm and everyone does their piece of work, and we can hopefully do the best we can in terms of maintaining capital markets during this period. And then obviously this is the last webcast of the year, so happy new year, and hopefully we'll see everyone and in January. We'll hear everyone. I guess some publications, and I guess this first publication here, I think we'll come back to this, the differences between IFRS and US GAAP. I think this is one of the most downloaded publications on the PwC website, and it's interesting because for those areas, a lot of areas interpretive, US GAAP, I guess, normally has a lot of literature and can help in terms of those areas if there's not specific guidance on IFRS. We have an in-depth on SEC immense disclosure rules for acquired and disposed businesses. This is one of the themes we'll be talking about. The requirements for, and I think that also covers pro forma information. And then we have practical guide for IFRS Phase 2 of the IBOR reform, navigating the SEC's amended regulation, SK disclosure rules, Argentine exchange rate related disclosure considerations, and we also have an in-depth looking at the impact of COVID. And we have a frequently asked questions on COVID-19, market volatility, and then I guess accounting guides for such as business, number of accounting guides such as business combinations. So there's a number of those in I guess, and they're very large. I think the business combination guide is, I think it's over 600 pages from memory. And then we're also going to talk about comment letter trends, and in this link you can see comment letter trends, and it gives very split of those by industry. So I guess let's get started here. So we're just going to put up the first question for our survey, get everyone warmed up. So I guess how prepared is your company for the implementation of IFRS 17? The IFRS 17 is I guess it's the new standard applicable for insurance contracts. It's effective in 1st of January 2023. I guess the issue here is that obviously it may, companies that are not insurance companies may have insurance contracts. The issue for FPIs is that this would be applicable retroactively. So if you're an FPI presenting 3 years of financial information, then you'll be presenting 2023, 22, 21. So your first time application opening balance sheet would be in a few weeks for IFRS 17. So the idea is here's for those companies, I guess for the companies to evaluate, how are they doing in terms of evaluation of this? We can see that most companies are still evaluating this standard, and I guess that this standard's been discussed for a long time, and one of the big concerns about this is the time it's going to take to roll out. And number 2, so which area of the annual 20F do you consider is going to be most challenging this year? So the financial, I guess, is a very atypical, very unusual year. So you think it's going to be the financial statements, internal controls, MD&A, risk factors, description of the business, legal proceedings. So yes, which part of the 20F do you think is going to be the most challenging for this year end? And then I guess that I'll just give you a few minutes to reply to that one. And I think we're just closing that, so we'll see what the challenges are here. I guess we've had the impact of COVID. It's impacted a lot of items here, and then let's see what people are expecting to be the major challenges. So we have, I guess, pretty well financial statements, internal controls, MD&A, risk factors with very little on description of business or legal proceedings. So I guess the four big areas of the first ones. Okay, let's go to the next question. In relation to the changes in the rules on additional financial statements and pro forma financial information. So I guess one of the publications we showed at the start was the publication on the rules for additional financial statements and pro forma financial information. I guess we're just trying to gauge how people have evaluated that. So we have read and understood the regulation but not formally evaluated. We've performed initial evaluation. We've evaluated the impact but not taken any decision. We evaluated the impact. We'll simplify our disclosures. We will simplify our disclosure and have drafted some changes. So I guess how have companies evaluated the impact of the new rules in terms of additional financial statements like acquisitions and related pro forma financial information? I think we're time's up here. I guess there's let's give it a minute. So as most, I guess the most popular one is read and understood the standard, and then I guess then split between the other items. in relation to COVID-19 disclosures in the 20F. Have you, I guess, first of all, read all the SEC guidance on this, prepared draft disclosures subject to review, benchmark disclosures against similar companies, prepared draft disclosures which have been reviewed by governance organs, or substantially finalized COVID-19 disclosures? I guess this is going to be one of the big issues for this year end, both in the financial statements and in the rest of the 20F. Is going to be the disclosures on COVID. And I guess the idea here is to identify how companies are dealing with that and how far along they are in terms of getting those disclosures into the 20F, and if they've already made them, and I guess the best would be to already have a draft of those disclosures in the 20F and the various areas of the 20F that would be impacted. And there again, with a mixture of replies from read, prepared drafts, benchmarked, and prepared draft disclosure, but I guess very few have finalized to date. So I guess that's going to be an area that's going to give work for these companies. Question here is, do you think ESG information could become as important as financial information for stakeholders? There's a lot of discussion on ESG information, and I guess the question here is do you think this could be as important as financial information for the stakeholders? Here in Brazil, we just had last week a new standard issued by the stock exchange regulator, which basically required that any company issuing reports in relation to ESG or sustainability, or integrated reporting would have to do in a specified format under the CPC standard OCPC number 9, and that information would have to be subject to a limited assurance report by an external auditor. So we in our local, here in Brazil, we've had the local regulator basically define the content of those reports, and that they all will be subject to assurance by an auditor listed with the CVM. So I guess that's going to be a big challenge for a lot of companies in terms of the information they're going to be at least the listed companies, in terms of the information they're presenting as of the end of this year. And interesting here, we have majority of people saying that it's going to be as important as financial information, either immediately or within the next. So the majority is clearly saying that within the next 5 years is going to be as important as financial information, and a lot of people say it is already as important. And I guess one of the issues related to that is that we've had a lot of regulation around financial information and auditing of that information, whereas for ESG information, we don't yet have a single global standard in that respect. So number 6, do you think ESG information should be required to be audited by independent third parties? So all ESG information should be verified today. Key ESG information should be verified today. ESG information does not need to be verified today or in the future, and ESG information doesn't need to be verified today, but will need to be verified in the future. And I guess as I said, for those companies, at least listed companies in Brazil who are producing ESG reports or integrated or reporting and doing integrated reporting, they already, I guess, the local stock exchange already defined the format, the content, and the requirement to have the assurance by a CVM regulator on that. So I guess that our local market has moved quite, I guess, quicker than at least I had imagined. So the poll has ended, and we're just waiting for a summary of the results. So we have all information. So the majority are going for key ESG information should be verified independently, and then with the second that all ESG information should be verified. And it's going to be interesting, I guess, because a lot of this information is going to be either in a separate ESG report that will be subject to a separate assurance report, or the information would be in in Brazil we have the reference forms, or I guess in this case in the 20Fs that I guess wouldn't be subject to a separate report. I guess so. With that, let's move on to Leandro Argito. So, oops, let me just go back here. So, Argito, we have so Argito is the global ACS IFRS leader and corporate responsibility leader for PwC Brazil. So, Argito, it's over to you.
Thanks, Kieran. Thanks for the new photo. I guess the other one was pretty young. This one is much more reflects the reality of the current stage of my age. Thank you. If we can move to the next slide, please.
Yeah.
So, you're going to say something, Kieran?
Well, yes. I'm just thinking that I'm just trying to remember the last time I saw you in a suit and tie. But I guess it may reflect the age, but not the dress code.
Yeah. Okay. Thanks, Kieran. Good morning, everyone. I hope you're all well and safe. Today I'm going to talk you through certain issues regarding. If you can go, just one slide back, please. Yes. No. One slide back.
Back. Yeah.
Prior one. Yeah. So I'm gonna talk you through certain issues regarding accounting, IFRS, and accounting practice adopted in Brazil, CPC, when preparing your 2020 year-end financial statements. So most of you who work in public companies and are required to file with the CVM your quarterly reports, your ITR, might have already gone through this, but it's never late to come back and revisit some of the issues and make sure that everything is being tackled prior to year. So the aim here is to raise some points of attention and not to go deep into the details of everything that needs to be tackled. Okay. Obviously, and unfortunately, we need to go through the impacts of COVID-19 on financial statements. Next slide, please.
Yeah.
So again, this presentation does not mean to be exhaustive, but to focus on main issues. So under COVID-19, we are covering impairment of non-financial assets, IAS 36, expected credit losses on financial assets, inventories, lease concessions, and debt restructure. There are other items and other potential impacts that may cause effects on financial statements, but we understand that these are the main ones, and we are going to cover these ones during today's section. Next slide, please. So impairment consideration under IAS 36, COVID-19 itself is not an impairment indicator, but the consequences of the measures taken to control the pandemic, like social distances, closure of shops, and other measurements that were taken, perhaps here in Brazil more rigidly earlier in the year, let's say second quarter. Now we see that things are moving is lower to some activities, but this kind of things, those things brought might have brought impairment indications to the recoverability of non-financial assets. So and when we have an impairment indicator, according to IAS 36, the non-financial assets, and mainly we are talking about PP&E and intangible assets, need to be tested for impairment. That means that you have to calculate what's the recoverable amount of the asset and compare that to the carrying amount. If the recoverable amount is lower than the carrying amount, then you need to recognize an impairment. So one thing that it's important to be taken into consideration is that when we are talking about goodwill and indefinitely intangible assets, those items are required to be tested annually, regardless if you have an impairment indicator, and they are required to be tested at the same time every year. So the standard does not allow us to take more than 12 months between one test and the other. So what's the implication here? During the year, we might have identified impairment indicators in connection with the measures that I mentioned about to control the pandemic. So if an impairment indicator was identified, then the entity would have to test the assets for impairment, as well as goodwill and indefinite-lived intangible assets, even if they were going to be subject to annual impairment tests. So let's say that the company tested all its assets for impairment in Q2, 30 June 2020. That does not relieve the entity to do the annual impairment test of goodwill and indefinite-lived life if intangibles, if the annual impairment test was annually performed, let's say in October. So that means that for those assets, we would have to test twice in the year. So this is something that needs to be looked at, carefully analyzed, and it will bring some attention for the year. We have a list of. Go ahead, Karen.
I guess I was just going to comment in terms of this. Just looking at the column of impairment triggers, and I guess what we saw even in March, there was huge declines in the market price of shares, I guess, which is a direct reflection of big declines in market capitalization. And it's been pretty volatile, that the market prices since then, and I'm sure a lot of these got down below book value. I guess that's going to be an impairment indicator for a lot of companies.
Yeah, I agree. Definitely. This is listed on the standard as well. The other thing that I wanted to bring is that during these times of so much uncertainty surrounding us, it's perhaps difficult to determine the cash flow. If you're going to calculate the recoverable amount based on projected cash flow discounted to net present value, the traditional approach would be to prepare one set of projected cash flow. During this time of uncertainties, it's more likely that the expected cash flow approach, which is on the Appendix A of IAS 36, under which you determine more than one potential projected cash flow depending on scenarios and circumstances, and then you balance them and determine what's the most expected situation in order to measure the recoverable amount. So rather than preparing one single projected cash flow, you might need to prepare more than one, and then an unweighted average based on facts or expected facts and circumstances determine what's going to be the recoverable amount.
Yeah, I can just imagine what a challenge that's going to be. That is for companies, that have historically only had one cash flow, and then in the middle of this pandemic, I guess creating different scenarios and trying to work out what those scenarios would mean, and I guess and getting the support. I guess, and all of this has to be auditable information. So getting adequate support for let's say an optimistic and a normal and a pessimistic cash flow scenario, and I'm presuming as well allocating probabilities to each one.
Yeah, it's not going to be easy. This year is not easy at all, actually. So just another challenge that all of us are going to face.
Hey, Leandro, it's Gary. If I can maybe jump in there. I think maybe a couple of points. Agree with everything you've said, and maybe just a couple of other points to add on there. I think with respect to goodwill, it's probably also worthwhile reminding folks that we have IFRS 10, which tells us that if you did do your impairment test for goodwill because there was an indicator in Q2 and you had an impairment, even if the conditions have gotten better, by the time you do the impairment test at year end, you can't reverse that impairment. So that's a point we've highlighted for folks, because I know for some folks the impact of COVID was cyclical. And by that, I mean the worst impact may have been in Q2, but then things have gotten better either because of government grants or there's some light at the end of the tunnel. But if you had an impairment at that stage, you can't reverse it by a year end because of that specific interpretation. And maybe one other point to make on the impairment triggers that you pointed out is, even though you you clearly need to do an impairment test if there are impairment triggers. I think what we've been suggesting to folks is, because the uncertainty in the current environment is so high, you'd almost expect entities to maybe provide more disclosure than they have in the past if there hasn't been an impairment. And so normally, all the disclosures are triggered by you having an impairment. But I think we said what would be very helpful, especially depending on the industry that you're in, if you've been negatively impacted by COVID. If you did do an impairment test and you were fortunate enough not to have to book an impairment, we have been saying investors will probably be looking for the information to explain, why there isn't necessarily an impairment, maybe just as important as if there has been an impairment. So something else to bear in mind in terms of potential additional disclosure things folks might want to think about in the current year.
Thank you, Gary. Excellent points. Excellent point. But yes, I think these are two things that need to be looked at and be carried with caution.
And maybe I just want to add one more point as well there, because I think it's very important as this discussion here is, from an SEC standpoint and filing, whether it's through an FPI or it's, your reporting to the SEC, it's very important that the sensitivity analysis, we are talking about those different scenarios and that clear disclosures. But don't forget there's as well some guidance in the SEC guidance in the FRM about sensitivity analysis, and that if there is a reasonable change in assumptions that could trigger an impairment, that it should be very clear disclosed and what that sensitivity should be. And the SEC has always been focused very much so on what a reasonable change in assumption would be. And in this environment, it might be challenging. What is a reasonable change in assumption? So, and to the point Gary just made, your situation has totally changed between Q2 and the end of the year. But looking back, if you see that, your revenue has been going, from one range to the other, how can you say that it's not a reasonable change in assumption, or the discount rate, or some of the market cash flows that you're looking at? So I just wanted to point that robust sensitivity analysis and foreshadowing disclosures in an SEC filings for impairment considerations are very key, and reminding transparent disclosures about that and what could happen in the future.
Yeah, thanks, Guilaine. Excellent. Next slide, please.
Okay, give me a second here.
Okay, now impairment of financial assets, expected credit loss. I think the main message here in this slide is to reassess whether there has been a significant increase in credit risk since initial recognition of the financial asset and the initial assessment made regarding the expected credit loss. So the first step is to determine in which stage the financial asset is, in stage 1, 2, or 3, and this is important because this will change whether you're going to measure that on a 12-month basis or over the lifetime of the asset. So depending on the changes that have been identified to the credit risk since initial recognition, may need to change the staging between 1, 2, and 3. And the other thing that I was going to raise here is that sometimes you need to assess this individually. So you need to go down into the details of your clients, of your of the counterparty which owes you that financial asset. Sometimes you need to assess the group of similar assets that have been put together in order to determine that. But the thing is, you need to reassess. You need to ensure that there has been or has not been a significant increase in credit risk since initial recognition, and take the actions toward that in order to appropriately classify them, stage them, and then measure them and to recognize. And again, as Gary and Guilaine mentioned, disclosures are very important as well.
I guess the other thing here, just looking at this, I mean, this would be like the 3-stage process for, required for long-term assets. But even for those companies using the simplified process, I mean, what we've seen is like different clients have been impacted in different ways. I mean, there's a big need now for stratification of clients. I mean, we've seen in 2020 how different industries have had different impacts, and even if you're using a simple calculation, you're probably going to have to separate out, industries and companies that have been, impacted worse than others, and how are you going to control that? And maybe that wasn't something you had to do in the past, but it's probably become an issue now.
Yeah, that's I agree. I think you're right, and that's why that's what I meant to say when I said that I need to go into the details of individual clients, perhaps. So it's a very different year. Okay. Can we move on? Slide 6, please. So inventories. We might have noticed reduction in sales volumes, lower sales prices, obsolescence, and idle capacity, among other items being around this year. Although IS36 does not scope in inventories, IS2 brings a similar concept of net realizable value to measure inventories as of balance sheet date. So the carrying amount of inventories cannot be higher than the net realizable value, otherwise it needs to be written down. Several of the measures taken to aiming to control the pandemic might have impacted inventories. So we need to be carefully looked at that. Although we know that some relief on those measurements over the year might have brought some benefits or might have brought some good indications for year-end. This needs to be looked at that. The other thing that I wanted to highlight, and this is very important, is the classification in P&L when you have idle capacity, which and unallocated overheads that cannot be capitalized as part of cost of sales. So this needs to be recognized directly in P&L. And when we say P&L, it's in cost of sales. It's not part of operating expenses, but in cost of sales.
Yeah, I guess that's one of the other things that people, I guess there's been a lot of discussion as well about, if you can call these expenses, I guess extraordinary, unusual, and I guess a lot of companies, there's been a lot of discussion as to how you classify all of the additional costs related to that. But as you said, it's just classify them in the income statement in the line item consistent with how they've been classified in the past.
Yeah, and there's a specific paragraph in IS2 that says that.
Yeah, I mean, just adding on to that, maybe, Kieran, I think that is another area where we've seen a heck of a lot of discussion and some pretty innovative ways of companies, rightfully so, trying to tell the story of what actually happened. But I think the point that Leandro made, that you make, is I think it needs to be in the context of IFRS compliance subtotals or categories, and there is guidance in IS1 that has some pretty specific requirements on when you want to include a subtotal or disaggregate a number, and you need to ensure that the disaggregation of that number still is an IFRS compliant number. And so it might be, for example, okay to split your cost of sales between unallocated overheads and other costs, or your normal production costs, but it would not be, for example, most likely acceptable to say, here's my normal cost of sales that I would have had if I hadn't had COVID-19. Here's the COVID-19 impact on my cost of sales, because that would be an APM or something that wouldn't be IFRS compliant. Maybe one other point to pick up on that that Leandro made on that normal production capacity. That's another area, to the extent that you are in a business or industry that is inventory intensive. We have had questions around what is normal. I think folks will say this year has been anything but normal. And again, my point there would be, I don't want to get into the details now, but to the extent that your production capacity has been impacted by COVID and it's not entity specific, it's probably worth looking around whether or not that has impacted what you would consider to be your normal capacity for a period of time.
Yep. Thanks, Gary.
And thank you, Gary. I would echo what Gary mentioned from an SEC standpoint on not creating gaps that don't exist. I would say like what would have been my your first point, right? What would have been my result if COVID was not there? And so there's been a lot of discussion and focus about it. So I would just be very careful on creating, and we'll discuss in further details if as we go through the webcast here on non-GAAP measures. But wanting to mention that definitely from an SEC reporting standpoint and all those subtotals or the way we report some of those impacts will be very much important. And creating or changing your presentation has to be very consistent from one year to the other. And the SEC has been focusing a lot on how companies have changed or not changed their reporting this year. So I totally echo the point about non-GAAP and making sure that this is compliant with IFRS on the way it's presented in the financials, and that it is clear and transparent on what is done. Like if any adjustment is made or split is made, and that it is consistently applied for the period and allocated appropriately between the different categories.
Thanks, Guilaine. Next slide, Kieran, please. So this one is related to the rent concession amendment that the IASB issued to IFRS 16. This is basically a response to the occurrence of several renegotiations that were being performed or negotiated between lessors and lessees during COVID-19 or during this time of all these issues that we have facing. Lessees were coming back to lessors asking for discounts for renegotiations because they were not able to pay the full rental amount that were initially specified in the contracts. So the question was how to account for that by the lessees, not the lessors, because this rent concession amendment is not available for lessors. When you have a renegotiation, should that be treated as a modification to the contract? So the IASB issued this amendment, and this is specific to lessees again, and it is limited to reductions in lease payments effects due on before 30 June 2021. So it cannot go beyond that date. This is specific related to COVID-19, so something that's not, well, depending on how the pandemic is going to be controlled, we see vaccines being produced and being already applied to people in other countries. But today, we don't have any indication that this date is going to change. So, and anything that's beyond 30 June 2021 would not be expected to be directly related to COVID-19. That's why we have this date. So, in what this amendment says, it says that when you have a renegotiation on lease payment, any concession given regarding payments that were going to be, that would have to be paid to the lessors, you don't need to treat that as a modification to the contract, which means that if you were doing a modification, you have to recalculate the projected cash flows, and then determine a new incremental borrowing rate in order to bring all the cash outflows to net present value, and then change the lease liabilities against the right of use the asset. What the amendment says that you don't need to do that. You just recognize the difference in P&L, and this is only available for lessees.
I guess just on that one, I mean, it's an optional practical expedient, and I guess I think it was created because without this, the analysis becomes quite complex in terms of trying to analyze the lessee accounting for a rent concession. I guess it's not something that was I guess would have been expected. And I guess the other thing is that this is for lessees, and I've seen a lot of discussion around issues in relation to lessor accounting as well. So I guess there's a lot of issues around this area, and I guess this was very fast for the this amendment came out very quickly to accommodate those companies applying IFRS. But I guess there's a lot of complexity around this, and even if you're a lessor, and especially if you're not using this practical expedient, there's a number of issues as to how you apply IFRS in these cases.
Yeah, reading the earlier drafts of the amendment, they considered whether they would extend that to lessors or not, and they eventually decided that would not be extended to lessors. I remember one or two cases of public companies that were lessors dealing with that with material amounts. But yeah, it's funny that we did not receive so many questions on that, Kieran, on the lessor side, at least here in Brazil.
Yeah.
Next, please. That's restructuring, modifications, or derecognition. So like IFRS 16, like lease payments, there are also occurrences of debt renegotiations. So the standard says that modification of financial liabilities are treated as derecognition events when the revised terms are substantially different from the original terms. And what does that mean? Under IFRS 9, the revised terms are substantially different. This is the trigger. If the present value of the new cash flow under the new terms is at least 10% different from the present value of the remaining cash flows under the original terms, using the original effective interest rate. So when you do all this calculation and compare both cash flows, if the difference is higher than 10%, it's at least 10% or higher than that, then you have a modification.
Yeah.
So the point that we make here is, you need to. It's a derecognition, and then you recognize a new financial liability, not a modification to the contract. This is how the standard says. Two things that we wanted to highlight here. The first one, if you entered into a renegotiation with a lender, you need to determine that. You need to go through this calculation, determine how to account that. If you have a derecognition of the previous one and recognition of a new one, or a modification that will probably impact your P&L directly. The other it's not only cash management. It's not only ensuring that the company will continue on an ongoing concern basis, but also there are accounting requirements that need to be followed and addressed. The other thing is that if you're on the other side, if you have a if you have a financial asset that has gone through a renegotiation or restructuring, the standard does not state how to assess that, and we understand that the same approach or the same rule that you apply for financial liability, you could apply for financial asset as well, in order to determine if you have a modification or derecognition. So whenever you have a restructuring in that asset or liability, you need to go back to the standard and ensure that you're accounting for that appropriately.
I guess another thing on here, just coming to the year end, are the financial covenants that many companies have, and financial ratios that are the basis of those financial covenants. And we've seen a lot of companies discussing with us that they're concerned about their covenants, and I guess that's a big issue for companies. If they're concerned about their financial ratios, they need to get waivers before year end to avoid reclassification of long-term debt to short-term. And we've seen also that a lot of contracts have cross-default terms. So if you break a covenant, even if it's on a small debt, a small amount of debt, because it's almost like a standard clause in a lot of debt contracts, the cross default, you may end up, reclassifying all of your long-term debt to short-term, and then that becomes a major issue for companies, leaving them in a very weak position after year-end, trying to renegotiate covenant terms with the banks. So I guess there's a few weeks left in the year. Is for the companies to make sure that they look at any that their covenants, make sure that they're confident that they're going to meet them for year end.
I agree, Kieran. IS10 is very clear on that. A waiver received after year end is post balance sheet event that does not adjust the balance sheet. So need to be, if you are in that situation, need to hurry. So this is what we wanted to cover on COVID-19. Of course, as I said, there are other areas, other issues that need to be looked at. And one thing that I guess we need to reemphasize, as Gary and Guilaine were very clear on that, disclosure is very important. We are surrounding with so many uncertainties, and in order to protect your financial statements, to protect your shareholders, in order to ensure that all the information is transparent and is fairly presented, disclosure is very important. We've seen over the year disclosure on COVID-19, and this was not one single case, but several ones. Entities saying that we have implemented home office, we have created a crisis committee, we have distributed masks and safety equipment, but we don't see detailed disclosures on what are the impacts to the businesses, what's expected to happen next year, what's the risk that the estimates that are used or the assumptions that are used to determine estimates might change over the near future and change the amounts that are recognized in the financial statement. And this is a requirement in the standards as well. They need to disclose that. So again, disclosure is very important when we have so many uncertainties. Next one, please. So main IFRS updates. Next one. It's a summary of the activities of the IASB. We are just going to focus on two of them, those applicable from 1st of January 2020, so over the last 12 months already. Definition of business in IFRS 3 and IBO reform phase 1. If we can go to the next slide, please. This is a summary of the activities of the IFRIC, but this is just for information. We are not going to go into the details here. Let's move to the next one. Right, definition of business. IFRS 3 was revised, and this revision is applicable from 1st of January 2020. The revision that we were going to cover in this presentation is the definition of business. Prior to the definition, business was defined, prior to the revision, business was defined as an integrated set of activities and assets capable of being conducted and managed for the purpose of providing a return in the form of dividends, lower costs, or other economic benefits. So this was changed. Now the benefits needs to be in the form of goods or services to customers, generating investment income such as dividends or interest, or generating income from ordinary activities. Although the words seem, let's say, simple changes, they are not. You might have a difference in having a business combination or acquisition of a group of assets if you apply the different approaches or the different definitions of the standard. So what business include inputs and substantive process that together significantly contribute to the ability to create outputs. And what are these outputs? Goods or services that I mentioned in the definition above. to customers that generate income and include return in the form of dividend. This was the prior definition. This is, I guess, the third time that the definition of business is changed in IFRS 3, but it's important to take that into consideration. The standard also brought a concentration test. This is optional in order to determine whether you acquired a business or a group of assets. So let's say if you're a mining company and you bought a mine, and let's say 95% of the fair value of everything you bought was that mine itself, or the ore that is in there, and you have 5% attributed to other assets, then you're probably going to conclude that you bought a group of assets under the concentration test. So industries most affected: real estate, pharmaceutical, oil and gas, mining companies, I said. Next one, please. Yeah, any question, Kieran?
No, I'm just going to say on the IBOR, one of the things we're discussing is that I guess this is mostly for, I guess there's relatively limited application of I guess this IBOR, and I'm just thinking of time here. Maybe if because I guess just pass it maybe the.
Let's pass. Go to one more. So additional local guidance. We have just one more slide, Kieran. Sorry if it took me more than expected. Just want to highlight three things here. Official Circular OC-CVM 04/2020 guidance on the application of IFRS 9 and IFRS 15 for energy transmission entities. Although these two standards are in effect since 2018, the CVM identified that there was diversity in practice by energy transmission entities regarding specifically RBSC, which is an amount that was not the amount. I'm not going to go into the details here because it's too complex. But these are assets that would be due by the government from the grantor, as it says in IFRIC 12, from the grantor. So many companies were treating that as a financial asset. Other companies were treating that as a contract asset under IFRS 15. And now CVM came and said, no, all of this needs to be treated as IFRS 15. Finance income needs to be presented separately from sales revenue. We are still analyzing that, but this is, if you are in this industry, in energy and specifically transmission, this needs to be very carefully analyzed and also analyzed regarding the prior year financial information that are presented as comparative information. The other one was the Official Circular CVM 01/2020. This was regarding the relevant aspects for 31st December 2019. Although it was 19, we understand that the next Official Circular CVM for 2020 will perhaps or probably include most of the items that we see that. One thing that I wanted to highlight is that CVM, when issued its final conclusion on the application of IFRS 16 or CPC 06 here in Brazil, agreed that IBR to be used was the nominal rate rather than the real rate. However, it requires additional disclosures, and CVM was noting that not all of the entities were presenting all of the disclosures required in its Official Circular. So this is something that needs to be looked at. Other under development, one thing is the one that I mentioned, the Official Circular for 2020 that CVM is expected to issue during January. And the other one is the revision of OCPC 06 pro forma financial information, which is under discussion. I guess Kieran has more details on this one.
Yeah, I guess on that one, that initial standard was based on the US Article 11 SEC standard, and as that is changing, then the local rule is also changing to reflect that. And I guess the other one that's I guess that's not here is this requirement on integrated reporting in relation to sustainability reports and ESG reporting, that any reports issued by companies in that respect will have to follow the format of the CPC, OCPC 09, and they'll also have to have a limited assurance report by a CBM auditor. I guess that's going to be quite a challenge for companies for this year end. As I think that both the format, content, and requirement for assurance are things that many companies didn't have in the past.
I guess this was all from my side. Thank you, Kieran. Thanks, Guilaine. Thank you, Gary. I'm going to be around if there is any other question, but thanks for the opportunity.
Okay. Thanks very much, Auditor. And maybe I'll just ask Guilaine, tell us a bit. Guilaine, if you could tell us a bit about your experience.
Sure, Kieran. Thanks for that. So I'm a managing director in our national office here in the U.S., located in New Jersey. And I focus primarily on our foreign private issuers or cross-border transactions, especially from many countries or territories that report under IFRS. And so they will do usually IFRS as issued by the ASB for SEC purposes. As well, part of the IPTF, one of the two PwC representatives at the IPTF, which is the International Practice Task Force. We meet twice a year with the SEC to discuss most of the foreign matters. And I do a lot with Brazil, so I'm happy to discuss here, and a lot with different other countries that I know may attend here, like in Europe or South Africa, Canada, Latin America. So, but a lot with Brazil. So, and I'm open for any questions, and we'll cover quite a few things here. But if anyone has any questions, I'm happy to take them.
That's great. And then maybe Gary, if you could tell us a bit about your experience as well.
Yeah, thanks, Kieran. So I'm a partner. Folks have probably been able to tell from the accent. I'm not British. I was actually born in South Africa and became a partner in South Africa. But I'm currently here on a global tour in England and in London. And I'm currently responsible for our global views around most of the accounting standards that relate to entities in the non-financial services space. So impairments for non-financial assets, revenue, share-based payments, all of the exciting stuff kind of falls to me and my team. And in that role, I think I play a coordination role of ensuring that we have a consistent view on the majority of the accounting implications for clients around the world from a PwC perspective, and help drive what the PwC global view is on ISP positions or on implementation issues. I spent a fair amount of time heading around the world. So started out in South Africa, spent some time in the UK, a technical group. I spent a couple of years in the US where I worked a little bit with Guilaine, and I was lucky enough to do a tour to the ISD as well, and was part of the team that wrote IFRS 15. So hopefully folks like that standard. Yeah, that's a short update.
Great. And I've just been seeing that whenever we've been talking here, there's been a number of questions that come in. So we've got Brett Lockedy, who's asking about the impact of COVID-19 on CAMS and the link to filers' disclosures. Because I'm guessing, I guess the impacts of COVID-19 are certainly, I guess, I would not be surprised if they're CAMS and going to be linked into disclosures. And I guess, I'm not sure, maybe it's Guilaine, if you want to comment on that, is that something that's going to be a big, a common issue in CAMS, or I guess the areas impacted by COVID-19 are going to be, I guess, like such as impairment and so forth, they're going to be focuses of CAMS, of critical audit matters in the auditor's report?
Sure, Kieran, happy to take that. And then Gary, please chime in on the disclosure piece from an IFRS standpoint. On the light side, I know I mentioned yesterday, one of the impacts, Kieran, on whether COVID-19 will have an impact on having snow days here in the U.S. So I'm happy to report that snow days are not canceled in the U.S., at least in New Jersey. We are expecting a snowstorm. And even with COVID-19 and most of the virtual school, we're still going to have snow days. So very important. COVID-19 is still having an impact there.
Well, I think you're gonna have to explain to us in Brazil what the snow days are. I think we haven't had any.
Yeah, I know. Here we are expecting a big snowstorm of snow here in New Jersey, and school is pretty much and businesses shut down very quickly. So a lot of the businesses are shutting down and schools are shutting down as of 2 p.m. today, including virtual schools. So at least in New Jersey. So that's what a snow day is. So tomorrow, I think you'll see a lot of kids playing around in the snow if that really gets to that. So that's what a snow day. And COVID-19 didn't change that, which was the most big worry from the kids, I think, as of last night. So one thing that is stable, with that lighter note on what the COVID-19 disclosure, I'm going to mention two things to answer the question from Brett on the disclosures and then the impact on the reporting here. One is the SEC has actually published guidance in COVID-19 related topic 9 and 9A, which really is two things. One, the disclosure to really allow registrants and investors to really understand the investors from an investor standpoint, what management believe in their eyes, what is the impact of COVID-19, both in the current period, but as well longer term. And I think at the SEC, we will mention a little bit later, but there was the SEC CPA conference last week, and that point was reiterated again that the disclosure and the impact should not be focused just on the short-term impact to the company, but what is the impact longer term potentially. It should be specific to the company. As I said, the guidance that is out there that I'm more than happy to share with anyone if you don't have the link there, topic 9 and 9A, is in the eyes of management. So it should be specific to the company and what management believes there. The other point that is very clear, it's not just the financial statements that are impacted here. So I want to make clear as well that as a registrant, a company should consider, and the auditors consider, each part of the 20F or the 10K, including the risk factors, the MD&A, the liquidity, and of course the financial statements, but as well the critical accounting estimates. And I think it is very important that all of those sections, and including controls as well, and we'll talk, we can talk about controls, but did that change anything from a control? Did we have to change anything from a control perspective? Is ICFR, did that operate the same way? Is there an ongoing concern issue coming in? Or there's new specific risk factors that didn't exist before, and we have some new rules on risk factors on top of it. So in this grand scheme, if I summarize, the disclosure should be transparent in the eyes of management, focusing both on the current and long term, and be specific to the company and make sure that you address it all the way through the entire filing of the registrant. If now I take to Embrace, let me know if that covers what you were looking there, but in case for the second part of the question, as it relates to the CAM and the reporting of the CAM, so with a C for the PCAOB report, which I know both companies and auditors are very much interested in. A few points I would make here. One is the auditor just report on the same estimate as what the company is doing. So the auditor would never disclose or report additional or new information that is not existing in the registrant's financial statement. So if there is an impairment issue and there is a CAM related to the impairment, then it is expected that to have similar discussion and issues on critical matters in the financial statement. There was a discussion actually, including last week at the SEC conference, on whether COVID-19 could be a CAM in itself. And I know there are some discussion in different countries about whether COVID-19 could be by itself like a CAM. From a U.S. and PCAOB standpoint, we don't believe that COVID-19 is a CAM in itself. It has impact on other CAMs. So COVID-19 might bring the impairment, and as part of the impairment analysis, like we talked about it before, there may be some specific COVID-19 consideration to look like on the cash flow and sensitivity, or it may become a CAM, impairment might become a CAM this year just because of COVID, and it was maybe not in the past. Or it might change because some companies are actually doing very well in the environment, and some are doing that not as much. So the point is, we will expect COVID-19 to impact the CAMs, but we will not expect COVID-19 to be a CAM in itself. And I think that's kind of the key message related to that at this point, the way we see it in the U.S. market.
Okay. Well, we have another question here from Lucas Fiocchi Albuquerque, who's asking whether, regarding IFRS 3, non-financial institutions tend to buy financial institutions, sometimes shell financial institutions that for which there are no relevant operations, which have financial licenses to operate. Will that be recognized as an asset, or will it be a business? I guess quite a loaded question, because the question, I guess the thing is here, I guess if it was just the license, if the company wasn't, if the financial institution, like a bank, if it wasn't operating and the only thing it had was this, was a license to operate, and it just that was the only thing that was being bought, it would probably be an asset. But once you get into a discussion about, a lot of these cases, that there are other things linked to it, like there's customers and processes, and then you normally have to do a deeper analysis on that. And then we had another question here from Patrick Matos asking any comment on impacts of remeasuring contracts under LIBOR and whether result in modification or extinguishment. I don't know. I guess the issue on I guess with the end of LIBOR, I guess those contracts that are still using it, there's a lot of guidance out there in terms of implications of the end of LIBOR, and I guess what it's going to be substituted for and how that's going to impact the accounting. We could, I guess if you have a question, I guess we could maybe answer that separately, because I guess based on our discussions, we had relatively little information on that, and I think we had we'll answer that one separately. And obviously that there's a lot of practical guidance out there on the IBOR reform, such as the one we're showing here that we passed at the start. Let me just get on here. So Gary, could you tell us a bit about what would be the impact on the COVID-19 pandemic on the accounting world? And is there a lot of new situations that require a lot of guidance, and whether the impacts that brought on due to the uncertainties related to the pandemic? Basically, have you been busy with COVID-19 issues this year?
Yes, I think the short answer to that, Kieran, would be absolutely yes. I think once it became clear that COVID-19 was a global pandemic, clearly that had massive implications in the real world from a health and business perspective. But then shortly thereafter, there were quite a few accounting issues, and I think the folks with the slides I put on there, we put out an in-depth, and I did a quick kind of scan of that in advance of this meeting, and I just looked. We probably issued around about 100 new frequently asked questions. So there's the in-depth, which has kind of the basic discussion around how you might be impacted, but as a result of the specific questions that were coming through globally, we set up a tracker, and folks all around the world in dealing with clients were submitting questions that we thought were pervasive, which led to us issuing new guidance, as I say, around about 100 new FAQs, which covered a whole lot of areas, the majority of which focused on impairments, both the financial and non-financial instruments, which Leandro did a good job of summarizing, but also implications around disclosure, leases. We had to look at government grants, IAS 20, a standard which I don't think a lot of people have looked at for the last however many years since it got written, and it's a very old standard. So we had to issue a fair amount of guidance on how to deal with a lot of the government programs or relief that was being provided to entities. Clearly, provisions was impacted as well. Some impacts around some other areas as well. But as I said, the key things for me was impairments and presentation was really some key areas that we had to spend quite a lot of time looking at and issuing some new guidance which specifically related to COVID. I think maybe one specifically that I'll mention that I probably should have done when Leandro was doing is TIAF is also don't underestimate the post balance sheet event period. I think everyone's very focused on end of the year, but I think we said because things are changing at such a rapid rate, just be aware that information you may receive post year end may become important in terms of is it actually non-adjusting, and therefore you wouldn't change anything in your financials, or is it something that provides you with more information about a condition that existed at 31 December. I mean, with the new vaccine hopefully out, the implications of how favorable or unfavorable that might be moving forward, I think is something that folks are probably thinking about. And, to the extent that new information gives you better guidance on how that might be impacted, I think there's going to be quite a few judgments around whether or not some of that new information is adjusting or non-adjusting.
Great. And
maybe on that point, Karen, maybe on that point, because it's a great point, I just want to mention as well something here based on what Gary was mentioning is one of the questions, and I know we shared and Leandro discussed a little bit the covenant and the breach of the covenant and the fact, if you get a waiver after. But one thing that has been interesting to me, and maybe it's only in this new environment that, we are starting to see those interesting questions coming in, but the impact of COVID, longer term, for example, and new loan agreement that got entered and new type of covenant that got entered. I started to get questions on what about if actually I'm expecting to, breach a covenant, in the short term. Maybe I will breach it before the date, or maybe, I know it's going to be breached by the end of the period, or maybe I know it's going to just to be by the date I'm supposed to report here. And so I just want to remind the attendants here two things, the participants here. One is, from an SEC standpoint, you have to disclose your known trends and uncertainties. So if there is risk to covenants, you may want to think about what the risk is and what the impact it could be in your financial statement and in the reporting. If you know you will breach because there's no way you can ever meet it, right, you may want to consider the guidance in IAS 1 on critical estimate and judgment and some material information, both from an SEC or IFRS, whether it's a material information that should be reported to an investors. So just something to think about as you are looking at your subsequent event and your long-term plans and all the new agreements that got entered into this period.
That's a great point, Guilaine, because even despite the classification as of the balance sheet date, obviously the investors are very interested in terms of what the expectation is for the future, and if there's a significant risk of having an issue with covenants in the future, it's obviously an important factor for investors. I guess in terms of the areas of the 20F, I guess where would you expect to see disclosures on COVID-19 impacts, and what sort of disclosures would you expect to see?
Yeah, I think I mentioned the main ones, but Kieran, as I was mentioning here, I think it's important to be covering each of the part of your 20F and see if there is an impact. I think that's kind of the short summary there, is just to make sure that you look at each part of it, risk factors, liquidity, going concern, and even one point that I mentioned before that, but just making sure as well, we are maybe covering here later on, but as stepping back, let's look back as well at the filing status. Did something change in your filing status as a foreign private issuer or as a domestic or anything like that, because the test is done as June 30th. And so maybe you may be more at risk now that with your market value has been changing, one way or the other, to increase or decrease quite a bit, and all your shareholders has been changing a lot. And so don't forget that one of the impact and one of the potential risk or changes that I recommend many people here to double check here is that there is no change in the filing status. Are you still a large accelerated filer? Are you a non-accelerated filer? Are you still an SPI? Because it has a lot of consequences, and we definitely have more discussion and questions here right now on the transfer from or the change from Ifrs to US Gaap because of the loss of status. So again, it's important to think about COVID-19 in each of the part of the 20th, but including whether there's like knock-on effect that happen due to the impact on the company and maybe changes that are, that needs on the reporting side. And don't assume that, your 20F should look exactly the same.
Yeah, and I guess it's interesting in terms of the disclosures and the recent case of the Cheesecake Factory. I don't know if you want to make some comment on that and their COVID-19 disclosures that caught the attention of the SEC. I guess there was a release that the SEC brought a case against the Cheesecake Factory for what they considered to be inadequate disclosures, where they call their operations sustainable during the COVID period, and then I think the case was finally settled. But it's interesting that this is obviously something that's going to be, I guess this is just an indication that this is going to obviously catch attention of the disclosures around this are going to catch attention of the SEC.
Yeah, it's a very good point, and I think and we can cover the other enforcement things there, but definitely the SEC has brought up a couple of enforcement actions around the disclosures and the information that was released by registrants. Like last time I checked, there was like more than 150 related cases that were COVID related. Doesn't mean that all concluded with like an enforcement action, but there was more than 150 cases related to COVID that were followed up by the enforcement, and including the one you mentioned here, where it actually got, I guess, settled and finalized early December. And the key point was, like you mentioned here, was about the transparency of what management was expecting and really whether it was actually the appropriate picture of what they really were having. And so in this case, a store, like a chain store, was reporting that, they had found a new way to really deliver their business and it was sustainable, and therefore they were, and so the SEC and enforcement for that was misleading disclosure, and was through press release that it was done, those disclosures from the company. So I definitely recommend having a really good look at your disclosures, whether they really reflect, and they could have, and including the financial statement, the press release, and everything is consistent with the understanding. And as I said, there was a lot of enforcement action, and the SEC has been looking at a lot of the outliers on that regard. So what they are doing, and maybe one thing to think about, is there's two initiatives that they are looking. They're looking at any trends on EPS. So they're like putting EPS data analytics, where they are looking whether you're like, they're trying to identify whether there's been any management of the EPS earnings. So they're looking really at all those EPS data that are reported there. And then they have this coronavirus steering committee as well, that it looks at like the consistency of the disclosures between companies. And they were, with that, I don't know, if you are like an airline company and 9 of the airline companies that they compare with have like an impairment disclosure and they have a going concern, and you're like the one outlier, definitely expect a couple of questions and potentially, further than that. So they are definitely looking at that on trends as uncertainties and outliers through data analytics, because don't forget that most of it, the information now with Edgar, is very easy for them and XBRL to actually compare the information, with a big focus on those COVID-19 disclosure and on NPS results and comparison in the same industry. So for that address that, Kieran, and that point you mentioned, I think it's a very important thing to follow, just for information as well. Sometimes how those enforcement actions are, there's always a lot of stories, and they always publish them a lot to make sure that it draws attention. But I think the message is not to be scared about it, but it's really to take the points and see how it applies to the company.
Hey, Glenn, if I can maybe jump in there, because I think, as I say, I think presentation and disclosure is one of the key things related to COVID-19, and if I try and maybe summarize it, I think there's three key things. I think the one is transparency. So telling your story in a simple, easy to understand way is really critical. I think there's a completeness angle. So make sure you cover all of the areas which may be impacted by COVID. And in the current environment, you would expect financial statements to provide a little bit more information, or maybe a lot more information as a result of the increased uncertainty. And I think the last point is just consistency. And that's consistency both on the story you may have told in your interims or your quarterlies compared to where you are at year end, consistency with your peer group in terms of the industry, and also consistency with other information that you may be putting out, and ensuring that, I guess, from a process perspective, the different functions within your organization are talking to each other to ensure that there is a consistent story throughout all the public information you're providing.
Okay, great. And maybe, Gary, as well, if you could tell us like a bit about what have been the main accounting issues that you've been dealing with this year.
You mean in addition to COVID or COVID related?
Yeah, well, I guess I guess both, just in general, because I guess COVID is a very broad spectrum of issues related to that.
Yeah, and I think I might have touched on it before. I'd say we've really had a look at IAS 36 and impairments of financial and for non-financial services entities. Obviously, for banks, it's been more around the ECL and how they've been impacted as a result of COVID and the forward-looking information. But I'd say definitely from a non-financial services perspective, IAS 36 and impairment of non-financial assets has probably been the standard that we've spent the most amount of time looking at. As I say, looking again at accounting for government grants has been a key angle. Leases has been a key area as well. And obviously, Leandro mentioned it resulted in a lightning fast amendment coming out from the ISB to try and address what was never anticipated when IFRS 16 was first put together. I think a going concern probably, and the going concern assumption and the disclosure around going concern has also been a major area that we've spent a fair amount of time looking at in terms of the level of disclosure one might need to provide and how that ties into other information such as the audit reports or the MD&A. Also spent, as I say, a lot of time looking at IAS 10 events after the reporting period and the judgments involved in determining whether or not new information that becomes available after a reporting period is adjusting or non-adjusting, because obviously things are so uncertain at the moment and they change so quickly that to the extent that they are adjusting or non-adjusting introduces a fair amount of judgment. So yeah, I think those are just some, as I say, to be honest, Kieran, it's mostly been around COVID-19. And then towards the back end of this year, it's actually come from almost nowhere, but environmental reporting and climate related reporting has probably been the thing that's gotten people very excited. I'd say it's been going on for a while, but over the last couple of months, I'd say it's accelerated to an unbelievable level of focus, both from a financial impact on financial statements, but also broader reporting non-financial information. So I'd say the two key areas would be COVID-19 and the related implications, and then maybe towards the end of the year, more climate-related matters or ESG-related reporting.
Okay. And I guess one thing for what we've seen for I guess almost the vast majority of foreign private issuers is that they report under IFRS, and obviously domestic registrants in the US report under US GAAP. And I guess for these companies that are listed in the US and reporting under IFRS, and should they be, whenever, I guess we've seen a number of areas under IFRS that require interpretation, and I guess there's a question as to whether these companies should be considering US GAAP in their accounting analysis, especially as they're listed in the US and maybe their investors, I guess, may have this reference, and I guess that there's a within IAS 8, if there is a level of interpretation, to what extent that they should be looking at national standards and US GAAP, especially as it's so detailed.
Yeah, that's a good question, Kieran, and I think that the challenge we sometimes find is that there's an area of IFRS where there's more guidance under US GAAP. I think sometimes there's an inclination of folks to jump straight to the US GAAP answer, and I think it might not necessarily be wrong or not acceptable under IFRS, but I think, as you said, there's a hierarchy in IS 8, and I think it starts out by saying, look, if there's other similar or related IFRSs that might deal with the related area that you're trying to make a judgment around. So I'd say the starting point would be having a look at that, seeing whether or not there's been anything that's come out of the IFRS Interpretations Committee, maybe looking to the firm's guidance or manuals of accounting to see if there's something that they've put out on it. And I think once you've kind of exhausted those avenues, then I think it absolutely, one would say, well, is there US GAAP that's on point? But I think there's maybe another step that comes after that, which is to say, are we comfortable that US GAAP guidance doesn't contravene or contradict any existing IFRS principles or requirements? In most cases, it doesn't. But I think in some cases, it might contradict a principle we have from an IFRS perspective. But again, if you're a foreign private issuer, chances are, I'd say that's very rare, which is why folks a lot of the time gravitate straight to the US GAAP answer. But I think it's just the process you go through before you necessarily get there is sometimes probably should be considered. But we're not going to get into trouble with the SEC if you end up applying a US GAAP interpretation that doesn't contribute.
It depends these days. They want to make sure it's compliant with IFRS. So I have actually seen that the SEC is more and more, very, very savvy with IFRS these days, and they want to make sure that it's application of IFRS as issued by the ISB. So I totally echo what you said, though, Gary, that I see sometimes people jumping too fast on the US GAAP, and sometimes it's just not what you would do under IFRS, especially and that's not my area of expertise here, but financial instrument can get you different answers, and sometimes, you get to totally different models. So I think we have to be always careful with that. And to your point, I think there's a lot of guidance or potential interpretation in IFRS first, and it's always good to check or understand if US GAAP would give you a different answer, because it could give you an indication that you may, have not thought about it. But to your point, it's important to go through the process and look at IFRS first. The one point I will add, though, here is in an SEC US market environment, it's very important, though, to think about IFRS as issued by the ISB and stay away from local interpretations that may have happened in the local territory. And that's where we see sometimes more trouble. It's not the fact that people are jumping to US GAAP. It's more that there was an interesting interpretation done locally, and it might become, IFRS as interpreted in Brazil or in somewhere. And the SEC wants to make sure that by mandate, it's IFRS as issued by the ISB. So I always really recommend to make sure that, it's not, you're not getting the guidance just from a local interpretation, and is that, the way that globally the firms and the companies and the IFRS ISB is looked at.
Yeah, that's a great point.
I guess, Guilaine, we've just had recently the ICPA conference on current SEC and PCAOB developments. And maybe if you could update us about that and some of the highlights of that conference.
Sure, happy to, Kieran. So the SEC conference is like almost 3 days conference, and people might be familiar with, we refer to it as the SEC ICPA conference or SEC conference sometimes, where preparers, the SEC, auditors are meeting and presenting. So this year, obviously, all was virtual. It was last week, Monday, Tuesday, Wednesday. And some of the key topics that were discussed included, obviously, COVID-19, but I think we covered, here, Kieran, almost all the points that was discussed, but of course it was very present. There was a lot of discussion on ESG matters, so I think it'd be interesting to discuss that point a little bit further, especially from, what Gary as well has been viewing and involved here. But it's definitely a point that is getting discussed a lot more in the U.S., and you may have heard that with the change in administration, there will be even more, we expect even more a focus on ESG. I was listening to the plan this morning from from the future White House on how much, budget they are going to allocate to ESG matters. It's a very significant amount, and how they are putting it together, a plan. And the SEC is, usually with the new commission, definitely is expected to follow on potential reporting matters related to the ESG, what the disclosure are, and it's the beginning, but we expect more on that, definitely. So there was a lot of discussion around that. There was a lot of discussion as well as it relates to non-GAAP measures. And we know it's a big debate or big topic that was discussed in the past. I thought it was kind of like going down a little bit, but it came back a little bit this year, and maybe because of the environment. But I think I would say on non-GAAP, the key message that I heard or that we heard at the conference is, let's be back to the basics, right? A non-GAAP should be not misleading. It should not create something that doesn't exist. So, for example, the example they provided, right? You cannot give like, here what would have been my revenue if COVID didn't exist, or here would have been my cost of sales if I didn't have to have all, this additional competition or something, or close the thing. So it has to be a debit or credit. So let's be back to the basic. A non-GAAP measure should be not creating or tailoring gap. The second point from a non-GAAP measure, it should be very clear on why is it useful and transparent to the investor. Why do we report a non-GAAP? It should not be prominent. So the GAAP measures should still be having more prominence into the disclosure that exists there. So I'm just putting those like very key here, but we saw a lot of creative reporting on non-GAAP, and then I would say consistency. So if you do an adjustment this year because now you want to present something else as a non-GAAP, you can, but you have to think about and consider whether a similar adjustment should be made, in the comparative periods that are presented. So I think that there were some of the key things, and then don't call a non-GAAP measure something that is not. So if it is an adjusted EBITDA, it should be disclosed as adjusted EBITDA and not as EBITDA, for example, because there's an understanding in the market of what is EBITDA. So that was the other point, Kieran, that was discussed, around in the conference. And then finally, I think there was quite a few other items, but enforcement, as we mentioned, it's always a very interesting, panel and discussion. But and then the last point I will mention here, a high level, was all about the new rules, because as you may know, the SEC has been very active this year and released a lot of new rules. You mentioned the impact on the pro forma, Article 11. So there was discussion on the new rules on acquisition and disposition of business and the new pro forma rules as well, and how the test and the new rules are working. There was discussion about the amendments and the new SK rules that are going to be applicable as it relates, for example, to risk factors and how it and what it is expected there. And then finally, some of the new rules that we are expecting to come, that we're still waiting the effectiveness, like on MD&A, contractual, stable, that will come as well for simplification here of the reporting. So there was the key message, and more than happy to discuss any further. But again, COVID-19, ESG, non-GAAP, new rules were kind of, in my mind, some of the major items here.
Great. Guilaine, and I guess just another item on SEC comment letters. I guess what issues are we seeing and can we expect?
Sure. I think the SEC in general, the comments have been pretty consistent year over year. There is consistency as well on like some of the key topics. So some of the key topics are like revenue. It's still very high. So Gary, Ifrs 15 that you worked on is still creating a lot of questions.
Clearly, we didn't get it right.
You got it right. I guess it's just difficult. So it's still a little difficult sometimes to apply, or it's just a very key focus here. The non-GAAP measures, like I mentioned, and I mentioned all the topics there. MD&A, there's more and more of a focus on the MD&A, I think. We have seen more comments coming here. And I think segments is still very high in the list. And part of it is like all the entity-wide disclosure, like the revenue entity-wide disclosure, for example. Do we have the right CODM? Do we have the right segments level? Is it really the way management, view the business? And is that consistent between what the company reports, in like the press release, investor calls, and is that consistent with what we see in the MD&A or in the 20F? So this continues to be a very big challenge, and we have seen definitely a lot of challenge coming through that in the recent 12 months, I guess, as well.
In the last couple of months of the year?
Yeah, sure, Kieran. And actually, I probably know enough, and some people know a lot more, because as I said, it's probably been going on, it's picked up a lot of momentum this year, and I think it probably kicked off, at least from an accounting perspective, towards the end of last year when Nick Anderson, who's an ISB board member, wrote an article that was posted on the ISB website about climate and climate risks and the types of disclosures or information that investors might be looking for, and how current IFRS standards may or may not be available to provide that type of information. And I think a couple of things that have happened thereafter is that the IFRS Foundation actually issued a discussion paper or a request for comment, where they asked folks whether or not they felt that the IFRS Foundation, who is the body that sits above the ISB, whether or not they should incorporate a new board that would sit alongside the ISB that would effectively look after non-financial reporting information, so ESG type information. I think the comment letter is coming to a close there. At the same time, or during this last year, that a couple of important things. So that the entities that currently look after ESG reporting, of which there are many, so the Integrated or International Integrated Reporting Council, or IRC, together with a couple of the other ESG reporting bodies like the Global Reporting Initiative and the SASB, they wrote an open letter to IOSCO, which is the global coordinator of all regulators, public regulators, of which the ACC is one, saying we need a coordinated approach to providing this type of information and having consistent requirements. And then actually towards the end of this year as well, in November, you had a coalition of investors who represent, or asset managers who represent more than 9 trillion of assets. And they wrote to some of Europe's largest and highest emitting companies like Shell, an open letter again, where they said, they require more information on the entity's approach to climate risk and climate change. And if they don't start getting this information, it was kind of implied that they might start disinvesting from these companies. And then very recently you had the ISB, I think, which followed on from Nick Anderson's article, issuing some educational material. So this doesn't form part of the IFRS body of material that is required, but it's educational material, which points out from an IFRS perspective the accounting standards that may be impacted today that folks may want to have a think about from a climate perspective. And I mean, I can go through the standards that they think. But I think the important point there, Kieran, is this seems to have picked up a huge amount of pace in the very recently. And so I think it's an area, and I reflecting on the poll you did right at the beginning, I probably echo what a lot of folks thought, that I don't think this is going away anytime soon. And I almost put it into two buckets. The one is, under our current financial reporting framework, so your financial statements, there is a keen focus on the areas of the financials that may be impacted by climate. And just for an example, maybe your useful lives of PPE, you may need to have a think about them if you're in an industry that's going to be impacted by climate-related matters, potential impairments, potential rehabilitation provisions, and a number of others. And so I think there's an impact on our financial statements today, climate-related, that folks really need to, I think, start thinking about once we get over the COVID hurdle, or at least even think about it this year end. And then there's this massive, I think, secondary focus area, which is going to be non-financial reporting. And I think on that, if I was a betting man, this is just my personal view, I think there's a very good chance that the foundation will think about creating a sister board to the ISB, potentially to try and bring all of these separate standard setters with respect to non-financial information together and start to try and get a single non-financial reporting framework and requirements together. And I think we, as PwC, just submitted our comment letter where we were broadly supportive of that as a way forward. Sorry, that's quite a lot, but as I say, I think it's the next hot topic once hopefully we get back to a degree of normality after COVID.
IFRS Foundation consultation, that there's a movement by the existing standard setters of consolidation, of alignment amongst themselves, and even there's the CFA have also made a movement in the direction of them creating global standards. But it looks like the IFRS Foundation has a lot of support at this stage. And I guess that's something that's going to unroll very quickly in the next couple of months as well. Yeah. Definitely. I mean, I think that they're the natural. I think it makes sense that the IFRS Foundation is the natural body that should pick this up, because if you think about it, this is effectively where financial reporting was, maybe 15, 20 years ago, where you had all these disparate entities around the world. But what I mean is local GAAP, where everyone had their own version of how they thought the accounts should be provided. And I think there was a push as a result of the EU coming together and a realization that everyone would be better off if we started with the same recipe if we're trying to bake a cake. The US aside, I think we nearly got there. But I think it's almost like we're in the same position now when it comes to non-financial reporting. And I think there's enough pressure from stakeholders and external sources and investors to move it forward. So I think I'd agree with the poll, again, just a personal view, that I think it's a space to watch, and I do think we'll be seeing some movements in this in 2021. I guess another question I would have in terms of within the companies, in terms of, I mean, it looks like they're going to be required to produce, I guess, to measure, control, report a lot of information. And do you think this is something that's naturally going to fall under the controllership, and I guess the same lines of reporting as financial reporting is currently, or could, is this something that the people listening in here linked to financial reporting that they need to get involved with, that this could well, I guess, fall under their remit very soon? I think so, Kieran. And again, it's just a personal view, but I think if you think about where this might go to, it's another avenue of communicating with investors. And although maybe that currently it's your investor relations team who looks at it, if we start getting requirements that are written in a way similar to an accounting standard, if you just think of the process and the control that companies have in place today over their financial statements, it does seem that you've already got the infrastructure to do the same type of thing. And it would sit within your finance function. I mean, again, similar to the way the ISB is going to look at it, you may kind of start creating a sister branch within your finance function that needs to look at the non-financial reporting. But I do think once we start to get requirements that look a lot like accounting standards, it might be that the logical place that goes to is the finance function. And again, not to alarm folks then, but I think you're right, Kieran, it does probably make sense to the extent that you're an FD or a CFO or a controller and you haven't been involved to date in this, to maybe dip your toe into it and start getting a feel for where it might be going, because there's a good chance it might become your responsibility in the not too distant future. Great. And then, Guilaine, maybe from the US side, I mean, I guess what are the implications and the views in the US market and for the foreign private issuers making their SEC filings and information that I guess is going to be expected to be reported in terms of ESG, and both in the environmental governance part. Like, I guess what can we expect on the US side on this?
Thanks, Kieran. I think it's a good question. I think it's interesting because I think it's an area that is slowly developing, and I think the U.S. in general here is a little bit catching up on all of that there. So you may know there's some discussion about new rules about human capital, for example, that are there that are not applicable to an SPI. However, I would expect a lot of the companies to look at that and see what is, whether it's relevant or not to them and what they would do there. I think the key question I keep getting these days is more about the fact that many territories, and like to the point that Gary is mentioning, is that there is like guidance that is taking there and more pressure outside of the U.S. especially. And so the key question that comes in is whether they would include or not include the same information in the 20F, and what are the procedures that are done and the controls around those information. So don't forget that, there's expectation that always the information in the data, and there's pressure to report on the data more and more around those ESG matters, then what is the implication into the 20F, and whether it's information to be consistent with what is provided in the local market and in the U.S. So this is an evolving. I think everyone is thinking about it and how it's going to be consistent, what controls exist and what the procedures are. And the other question I get a lot is if there is a report that is, expected in the local territory on it, like an audit report, what standard is it going to be, and would that be acceptable with the SEC? So in general, right, the SEC is expecting PCAOB or US GAAP, depending on the level of the information and what reporting we're talking about. And I'm not sure yet that we have a lot of, companies that have done a PCAOB report on ESG type matters, but there's more and more discussion about it and whether that would make sense. But the local reports, if there was another standard, at this point, we don't see how it will be, accepted or there, but it could be furnished if it was mature information. So I think there's a lot of discussion, a lot of questions, not that many answers yet, Kieran, and I understand that, and maybe it's a question for you. I understand that Brazil has actually issued some specific guidance here on the ESG and reporting matters. So I'm sure we'll have more discussion on how it impacts the foreign private issuers and what they would include or not include in the SEC filings based on that, Kieran. Is that correct? There's more guidance coming in CBM and local territory?
Yeah, as I said, that at least here in the local market, any listed company that wants to publish a sustainability, like an integrated report, or like a sustainability report, ESG report, they have to do so in the local, like following a specific format and content defined by the local standard setters, CPC under CPC 09, and they also have to have a CVM auditor issuing a limited assurance report on that. I'm sure that once they start issuing these reports, there's going to be questions as to whether these reports can be included within registration statements and offering documents, because presumably they would be furnished naturally under 6K, and as you say, like I guess currently you wouldn't expect these to go into registration statements, but I'm sure this is something that's going to evolve because based on the survey as to the relevance of this information for investors. So I guess it's something to keep an eye out on the future, and I'm sure we'll be discussing this again very shortly.
Totally great.
And Kieran, maybe one other point, because I know sometimes I struggle to make the distinction. I think it's important for folks to, in my mind at least, draw a distinction between this broader non-financial reporting and where that might go, and what might be required today under your local regulations. But also there's an immediate impact, because I'm thinking folks are thinking it's the 16th of December and they're thinking about their financial statements and year-end right now. And I think it's important not to lose sight of the fact that there may be implications today on your financial statements that you, in addition to kind of all the stuff we've been talking about COVID, that folks need to at least have considered in preparing their financials, so that you don't fall foul of anything. And I just posted two articles in the chat for everyone, because I'm not sure if we shared them before. But there's the ISB educational material, and there's our PwC in brief, which just describes in summary, what you need to think about for kind of your year end now in terms of the impact climate might have on your financial reporting, your annual financial statements.
Yeah, I guess that's a great point, Gary, because I guess the expectation would be that any of these issues that would have an impact on the financials should at least be considered and in there at this time.
And so, I mean, Kieran, sorry to jump in, that's a really good point, and I think it's a risk that folks need to be alive to, in that if you have got a broader ESG report, or you've got something related to climate or an integrated report, and you're talking about, we're worried because of Paris Accord, or it may have an impact on us because in the industry we're in, we can see because if you've got to go net zero in 2030 or 2040, it may have implications, and you talk about 5 or 6 different areas, and then you say nothing about it in your financial statements when there may be an implication relating to decommissioning provisions or potential impairments. I think, again, as I said before, the communication between the different functions in an organization is probably a bigger focus on it this year end more than any other as a result of both COVID and climate-related risks.
Great. And Guy, maybe could you tell us as well about some of the IFRS standards and ISB projects that we should be keeping an eye on for the future?
Sure. So yeah, I mean, and when you say the future, I'm sure it's when folks once we're done with all of the very difficult things that Gary, Guilaine, and Kieran have just pointed out now, I think some to focus on in the future that might be exciting. Well, clearly IFRS 17 if it's going to be applicable for you as an insurer, but maybe on the non-financial services side, I think very interestingly the comment period is closing on the goodwill impairment discussion paper. That is definitely one to watch, because it's not just about how we might think of doing an impairment test moving forward for goodwill. There's also actually quite a lot in there about new disclosures that the board is considering bringing in related to business combinations. And if I was a preparer, I'd be thinking, A, am I going to be able to get this information? B, this is a massive amount more of information, and some of it is the type of things that in the past you would have probably been more comfortable including in the management discussion and analysis rather than the financials. So folks may want to take a read of that. As I say, it's a discussion paper at the moment, but maybe prepare yourself for the exposure draft. There's business combinations under common control, which I know if it's important for you in your territory, then folks get very excited about it. If separate financials is not, I know in the US it generally doesn't generate a lot of excitement, then potentially not.
Well, just on that point, that is a major point for Brazil, because the standards in Brazil have been, including for the separate financial statements, so what we call them individual financial statements, have been fully aligned with the IFRS standards. So and there's a lot of, I guess, local interpretation currently in terms of how these transactions are treated in the separate financial statements, and that has a direct impact on the income tax treatment. So that's a very sensitive issue, and it's going to be potentially any changes or definitions in that respect will be very sensitive to that in Brazil.
Yeah, so as I say, that might be one that folks may want to also have a look at. As I say, the discussion paper was just issued, so there's still a fair amount of time to get involved. And then maybe the other big one I'd say is the post-implementation review of IFRS 10, 11, and 12. So again, to the extent you as a preparer have had frustrations with the new consolidation standard or the joint arrangement standard, or the disclosures thereon, the board is now undertaking their post-implementation review on those 3 standards. So if there's things you want to change, now's the time to get involved in that. And then there's a couple of smaller ones in terms of amendments to accounting policies and some stuff on taxes, on deferred taxes. But those are probably the big ones that spring to mind immediately.
Okay, great. And Guilaine, maybe can you tell us about some of the SEC changes to the rules that could have impacts, or to modernize the disclosure requirements?
Sure, Kieran. I think I will mention a couple. So one is, I mentioned earlier on the SK rule 101, 103, 105, and I think I will start with that. With the one that is applicable to a foreign private issuer is actually the one related to the risk factors. So you may know that, so it's at K105, it says that it's not applicable to foreign private issuers in their 20F. However, the way the rule works is that it is applicable for any new registration statement, or whether that 20F is actually incorporated into an existing registration statement. So, and I know a lot of the foreign private issuers out of Brazil or other countries definitely usually have an F1 or an F3, I should say, on file, or if you do an F1. So for an IPO. So I think it's very important that to not forget that it's actually expected to be applicable in a lot of cases for a foreign private issuer. What does that rule say? It's really just focusing on the fact and changing a little bit the disclosure of risk factor from being like what significant risk factor exists to what are the materials for risk factor, back to being simplified guidance and focusing on what really matters to foreign investors, right? So we have all seen long discussions and risk factors of everything that could happen, right? And so the SEC is trying to say, no, we really want you to focus on the material risk to the company. There should be relevant headings for each of those risk factors. And then finally, if there was more than 15 pages, which actually happened, there should be a summary of those. So that's one of the first rules related to risk factors that, will impact foreign private issuers here. The other rules that have generated a lot of questions and still continue to generate a lot of questions is the new rules related to the significant test and the acquisition, so the separate financial statement when you have a significant acquisition or disposition. And it has an impact as well on if you prepare separate financial statements for an equity investment. So the investment test has changed, and based on time, I will not go into all the details here, but we have good publication there, and it applies both to foreign private issuers and domestic. There's some nuances, obviously, as always, for foreign private issuers, and more than happy to take them. But I think the key message here is if you enter into a new registration statement for calendar year end after January 1st, 2020, so I should have said if you start and you will file a new registration statement after January 1st, 2021, so in just a couple of weeks now, the new rules will be applicable as it relates to the new significant test, except a couple of transition disclosures as a transitional rules that could impact some of you here. In general, the new rules will be applicable. So make sure, my message there is make sure you consider those new rules. The significant test change, which in general, the key message there is, in general, it should reduce the number of times that you actually have to provide separate financial statements, especially for a new acquisition. It reduces as well the level and the number of years provided if you were significant. So instead of having potentially 3 years of separate 305s, like we call them, it will be maximum 2 years. And then you will report a disposition as a pro forma if it reach out the level of 20% versus 10% in the past. The key message, again, the significant test is changing. So make sure, you think about that and you look at it, which means as well, there's a lot of detailed guidance that existed on the old rule, which is in the FRM, so the SEC guide, I always call it. All this guidance has not been updated yet for the new rules. So just make sure that when you look at guidance and you look at details, you're looking at the right rule, is my message, and the right interpretation guidance that goes with it. The other point, Karen, like you mentioned, and it could be a totally different session here on Article 11 and pro forma. So if you enter into a transaction and there's pro forma information, which I know it happens quite often based on the discussion we are having here and the participants here, the guidance, same thing, is changing for Article 11, and it's quite a significant change on the way the adjustments will be presented. So again, very important to understand whether you're in the old rule or the new rule as it relates to the pro forma information in Article 11. And don't assume that what was the case in the past and the way you prepare pro forma is the way it will be done in the next filing. So there are some of the key ones, Karen, that I wanted to mention here. And for, as I said, the significant test change, has as well an impact on the separate financial statement for 309. So if you have like separate financial statements due to an equity investment, that could be significant. And the asset test in this case, which I know applies a lot more for foreign private issuers here on 309 or separate financial statement for equity investment, the test for asset test is still the same. However, the income test now has two pieces, one which is based on revenue and one which is on income. So something to look at, and it could drive different answers. So I think they were kind of the key ones here, and I know we're running out of time, so I just want to make sure that people knew there were a lot of new rules coming, and then making sure which one they are applying.
And I guess any final comments for the company, I guess these companies getting ready now for the year-end closing and preparing the 20F?
Hopefully, I guess that's for me here. Hopefully we covered a lot here today. Maybe it's a lot, and I know there's definitely a lot of different publications out there. One additional publication I would mention here is that if you're looking for the summary of some of the topics we discussed at the SEC, SCPA conference that were discussed there, there's a great podcast that you may want to listen. It's not that long, and it really gave a good summary of all the key items that were discussed, and I know it's a common questions that we're getting. And so I think it's just my only last point here as year-end comes. Don't hesitate to, engage early with both your auditors, the companies, and the reviewers. And I'm more than happy to discuss after that any questions or any other information that will be needed.
Great, Guilaine. And Gary, any last words from you about this year-end closing, and or any tips for the companies?
I guess maybe just because I realise we're out of time, I'd summarise it as consistent, transparent, complete, and clear. Kind of stick to those four principles. Hopefully, everything will be okay.
Okay, that's great. Thank you very much, Gary and Guilaine, and it's been great having you with us today. And I guess we have to go through for those people who are doing the local CRC training, we have to go through the questions now. So thanks very much, Gary and Guilaine.
It's our pleasure. Thank you, Kieran. Great having you. Bye.
Bye.
Thanks. Bye. And I guess now for those people who need who are looking at this CRC training, we're not doing we're not going to be going through the 4 questions, and then you should be looking at getting 3 of these 4 questions correct. Let's see. So in question 1, what standard has its effective date in the future? So which standard has been issued that's going to have an effective date that's not effective at the minute? IFRS 17, IFRS on insurance contracts, IFRS 16 on leasing contracts, IFRS 9 on financial instruments, or IFRS 15 on revenue. And as I said, we're doing these polling questions for those people who want the certificate for formal training for local CRC purposes. And there's so we're just going to go through 4 questions, and then you have to get 3 of the 4 correct, and our system records those who get them right. And then, as part of the requirement as well as having been for 90 minutes on the connected, you also have to get 3 of the 4 questions correct. So I guess the time's just finished on this first one. The correct answer was IFRS 17. Put the contacts up here. So I guess here we have the contacts for our speakers today, and feel free to contact them directly. I guess for any follow-up questions, and we thank them very much. So, yep, the vast majority of people got the first question right on IFRS 17. So let's go to the second question. What's the effective date for IFRS 17 on insurance contracts? Is it affected 2020, 2021, 2022, 2023. And here we're talking about the effective date of the new standard for insurance, which we're covering. I guess a standard that's taken a long, I guess it's got a long lead-in time for application. And I guess is it applicable this year, next year, 2022, 2023? And I just choose the option. And then I guess we're in the second question here. And then I guess just thinking about the future, I guess this webcast finished the webcast for this year. And the polls just ended. The correct answer was 2023. Got a lot of disparity here among the answers. Correct answer was 2023. We will be repeating the question for those who didn't get it right the first time. So question 3, what are the expected challenges in the 2020 IFRS financial statements? IFRS COVID-19 measurement and recognition, COVID-19 disclosures, IFRS 16 amendment, or the practical expedient, or all of the above. So I guess which of the issues we've been discussing here in terms of implications for the 2020 financial statements. And then I guess just to this is the last webcast for this year. I think next year we're planning our webcast first webcast on the 13th of January, and I guess it's going to be in Portuguese, and we're going to be discussing the year-end closing issues. So for those, and that's going to be the first webcast of 2021, and I guess next year we're going to be back early in the year with that. The vast majority of people got it right. It's all of the above. So both COVID-19 measurement, COVID-19 disclosures, and the leasing amendment. And finally, the SC regulations in relation to 20F disclosures in general are to increase the amount of disclosures, simplify disclosures, align disclosures with European regulators, align disclosures with non-European regulators. I guess when I say simplify, I guess the second item is simplify or modernize. So it's increase the amount of disclosures, simplify or modernize disclosures, align disclosures with European regulators, and align disclosures with non-European regulators. And I guess this is the fourth question, and I guess that for those people who got 3 out of 4 correct, that's our system will have recorded that, and you should be getting your certificate in the next couple of weeks. And I guess our year-end message: Happy New Year, Merry Christmas to everyone. Hopefully we'll see you next year. Now, for those people who didn't get 3 out of the 4 correct, we're going to repeat the questions just now. So so the correct answer here on this one was to simplify or modernize the disclosures. So B was the correct answer. So we're just going to repeat this now. So starting with what new standard has an effective date in the future? Is it IFRS 17 on insurance contracts? Is it IFRS 16 on leasing contracts? IFRS 9 on financial instruments, or IFRS 15 on revenue? So I guess here, which standard is currently not effective and there will be and has a defined date to be effective in the future out of these 4? And then just choose and submit. And I say this, we're just repeating now that the 4 questions for those people who didn't get 3 out of the 4 questions correct. So and I'm just going to go back here to show that so it's just finalizing. Now we have the poll as ended. We're going to go to the systems recording the replies. Now we're going to go to the next one. So what is the effective date for IFRS 17 for insurance contracts? The effective date is starts on the 1st of January. So is it the 1st of January 2020, or is it the 1st of January 2021, or the 1st of January 2022, or the 1st of January 2023? And there you got the 4 options, and the let's choose between those four insurance contracts, and just waiting. And I guess based on so we're just coming to the end of the time for this one. Just finalizing. The time the poll has ended. The correct answer was 2023. The correct answer was it will become effective as on 1st of January 2023. And the issue that we were commenting on was that for FPIs that present 3 years of financial statements, there will be 2 years of comparative financials, which would be 2022 and 2021. So the opening balance sheet date would be 1st of January 2021, which would be in a few weeks. So we hope that those companies with insurance operations contracts that they already have their policies and the data that they will need as of 1st of January identified so that they're going to be able to apply this adequately. So question 3 is, what are the expected challenges in 2020 IFRS financial statements? So we're talking about COVID-19 measurement recognition, COVID-19 disclosures, IFRS 16 amendment, the practical expedient, or all of the items above. And so it's coming to the end of this one, and the poll is ended. The correct answer was all of the above. And with that, we're going to the last question, and we'll just put up this slide here for. So Happy New Year for everyone. So the SEC regulations in relation to Form 20F disclosures, so the changes in this year were to increase the amount of disclosures, to simplify or modernize the disclosures, to align disclosures with European regulators, or to align disclosures with non-European regulators. Is what was the objective of the changes in the regulation that, as we saw, for example, we discussed in terms of risk factors. So was that to increase the amount of disclosure, to modernize or simplify the disclosures, to align with European regulators, or to align with non-European regulators? This is the last question. I guess with that, the webcast for today is ended. We thank everyone for their participation, and hopefully we'll see everyone in January for a webcast on year-end closing in Portuguese. Thanks very much, everyone. With that, we're going to end. Thank you.